Firstly, many thanks to Insurance Ireland and to Kevin for the kind invitation to speak at this year's European Insurance Forum. It's a great pleasure to be here this morning. Last year, of course, attention was focused very much on the implementation of Solvency II, which had been so many years in the making, and Paul has already mentioned about where that's getting to and the reviews that are going on in EIOPA. I'm sure there'll be more discussion about today. And we will continue, and we can continue to discuss Solvency II and how it has been embedded in the regulatory regime. However, in my prepared comments this morning, I'd like to turn my attention to a couple of other aspects that are currently of interest. In particular, I'd like to talk a little bit about the European single market in financial services, including, of course, insurance, and about some of the current challenges and how they are being addressed. Of course, the single market refers to the EEA as one territory without direct or indirect obstacles, including regulatory obstacles, to the free movement of goods and services. And while that concept existed since the founding of the Treaty of Rome in 1957, the single market in financial services only became truly operational with the adoption of the Single European Act in 1986 and then the Maastricht Treaty in 1992. And the period since then has seen the realization and ongoing deepening of the single market in financial services, based in particular on the ideas of mutual recognition and passporting rights for cross-border business. Now, the benefits of the single market for financial services are considerable, whether it be in the form of the funding of business, the management of risks, the making available of investment opportunities, or simply planning for and supporting people's lifetime activities. Financial services are essential to well-functioning and successful societies. The single market has and continues to allow these activities to be fulfilled more effectively and more efficiently than ever before. The single market allows for the creation of deeper and more liquid financial markets, better risk diversification, better capital allocation across member states, and therefore more effective financing of the economy. It is essential to the smooth transmission of monetary policy in the euro area. And while further benefits remain to be realised, it has promoted competition and innovation across EU borders, pushing down costs and increasing the provision of products and services for businesses and customers. The enhanced realisation of the benefits of the single market in financial services remains an important continuing focus, including for financial regulators and amongst them the Central Bank of Ireland. For us, a particular focus of this effort is our work as part of the European supervisory authorities, the ESAs, and in the case of banking as part of the Single Supervisory Mechanism, the SSM. As part of that work, we seek to drive forward the completion of a single rulebook for regulatory purposes and supervisory convergence in terms of how that rulebook is interpreted and applied. For the Central Bank, this work is a significant priority and one to which we commit material resource, significant time and a great deal of effort. The single market in financial services is, however, just that, a single market. It is not, at least at this stage, a financial services union. For example, outside of the area of banking, we do not have a unified regulator or regulators for any of the different sectors, with certain specific exceptions, for example, in the oversight of credit rating agencies or trade repositories. And indeed, even in the area of banking, the banking union remains far from complete. Now, this state of the world reflects the current state of political will as determined by our democratic institutions. This may, of course, change over time, but it is not my role here to speculate on this. Rather, it is my role to note that this is the current dispensation. A certain amount has been decided that it should be achieved, but not beyond that. It's not the role of regulators to preempt or to prejudge the political determinations in this regard. What I do want to do, however, is to note some of the challenges that arise in the context of the single market in financial services in its current configuration, and to consider what is or might be done to address them. And those challenges arise under basically two broad headings, if you like, regular or ongoing challenges, and secondly, Brexit-related challenges. Clearly, one of the most significant ongoing challenges in respect of the single market in financial services is ensuring a level playing field. Now, this is a core aspect of the mandates of the European supervisory authorities, and I will not reprise here all of the very good and important work that has been done in this area, both in terms of the development of the single rule book and then in terms of its converged application, in particular by the large amount of high-quality supervisory guidance that is now available from the ESAs. Again, for the central bank, the achievement of a deep level playing field is a high priority. We are strongly engaged with the work of the ESAs in this regard. But perhaps an area where there is room for further development is that of supervisory convergence around practices and implementation. This has been the focus of increased attention by all of the ESAs over the recent period, which is very welcome. It is an area that, in our view, should continue to be focused on. As we have said in our recent submission to the European Commission's review of the work of the European supervisory authorities, we think the peer review process is one where improvements could be sought, though we acknowledge that there are constraints currently on the resourcing of the ESAs. At the central bank, we particularly like the fact that EIOPA, and Manuela is sitting here beside me, that EIOPA has established an oversight and supervisory convergent department with a dedicated supervisory oversight team, a sort of a SWAT team. The team's mandate is to drive the quality, consistency and convergence of supervision by bilateral engagement with NCAs on their supervisory practices. This approach could be further developed in EIOPA and could also be applied in the other ESAs. I'll say a little bit more in a moment about how Brexit is also driving quite significant developments in relation to promoting convergence amongst the authorities. A further challenge revolves around potential mismatches arising from the home authority, host authority division of responsibilities. One example of this is the case of prudential authorization and supervision. Such authorization and supervision is carried out by the home state authority, while the activities may be carried out either by freedom of services or freedom of establishment, as you all know, in another member state. Now, in general, that is a very good model. It allows business to be carried out on a cross-border basis and customers and clients to enjoy the benefits of enhanced competition and a wider range of service providers. But there are also aspects that need to be taken into account and appropriately addressed. Firstly, there is the risk that in certain cases the home state authority may not be well placed to understand the risks that are being undertaken by the regulated entity in a host country. Now, this is likely to be the case only in a limited number of circumstances, but nonetheless needs to be guarded against. To this end, at the central bank, we consider it desirable that the home authority consults effectively with the host authority. Any consultation process in relation to authorizations must, of course, ensure that operational efficiency is maintained and that the integrity of the decision-making process continues in order to ensure accountability. Now, there has already been developed a similar procedure along these lines within EIOPA, where the revision of the general protocol, or the so-called the Siena protocol, includes a process which requires the home competent authority to interact and discuss issues with host competent authorities where an entity writes or intends to write material levels of cross-border business. And it is timely that I'm speaking to you today. This revised protocol was entered into force just recently on the 1st of May. Secondly, it is very important, in order to maintain confidence, that there is no misunderstanding of where the business is being run from and who it is being supervised by. This should not become obscured by, for example, a complicated set of agent arrangements. We welcome the requirements in Solvency II as to disclosure in this regard, where there is a specific requirement for insurers operating on a freedom of services or freedom of establishment basis to disclose to the policyholder, prior to entering into a contract, the location of its head office. Any documentation issued to the policyholder is required to convey this information also. Now, following the recent well-known failures of insurance undertakings operating on a cross-border basis in the Irish market, and we've heard mention of the Setanta judgment already this morning, the central bank carried out an initial review on how consumers are informed of the name of their insurer and the member state where its head office is located. There are specific requirements in this regard in both the central bank's Consumer Protection Code and the EU Insurance and Reinsurance Regulations of 2015. The central bank has issued a letter outlining the provisions in the regulations and requiring relevant firms to review all policy documentation and take any necessary actions to ensure that this information is closed in a way which can leave no doubt, nor disguise, diminish or obscure in any way this important information. This information should be provided in a way that best informs the consumer so they know who the underwriter is, particularly when dealing with a broker. Thirdly, it is suboptimal that in the single market there is no harmonised approach to dealing with the failure of an insurance company. As we have seen from the financial crisis, the arrangements that govern what happens when a firm fails are hugely significant. And we saw this particularly in the area of banking. This means that a key part of achieving a truly single market is having a harmonised approach to recovery and resolution. We welcome the current work of EIOPA in this regard, and we look forward to the finalisation of its views following its recent public discussion paper. Now, turning briefly, before I finish, to Brexit and the challenges that it poses for the single market in financial services. Like other sectors, the UK insurance industry currently enjoys the full benefits of the single market passport that I have been describing. Post-Brexit, given the UK's intention to leave the single market and to no longer be subject to the jurisdiction of the European Court of Justice, it seems likely that such passporting will come to an end. This will undoubtedly change the configuration of the EU insurance market. The UK insurance industry is the largest in Europe with considerable levels of cross-border activity. Brexit, therefore, is likely to result in a relocation of some financial services activity, including insurance activity, away from London and into EU27 member states. As you will be well aware, this process is already underway. At the central bank, we have seen a high level of interest and engagement from financial firms who are exploring the possibility of relocating their operations, or some of their operations, into Ireland. We have had inquiries from very many firms of many different types. Engagement is currently ongoing with a large number of such firms, and the picture is a similar one across the different sectors. As UK-based firms make decisions on which member states to relocate to, one of the risks is that regulatory differences could emerge across the EU27, and that this could result in firms making decisions not on appropriate grounds such as business model fit, workforce considerations, accessibility to their market, etc., but rather on the basis of seeking regulatory advantage, something that should not happen within the single market. Take, for example, the question of substance or substantive presence, which relates to how much presence a firm needs to have in a EU jurisdiction in order to be authorised there. And this question matters because unless a firm is actually running the authorised business from the EU jurisdiction where it is authorised, then the business is in fact being run and therefore being supervised elsewhere. And one of the things we want to avoid is that firms doing business in the EU post-Brexit are not in fact subject to EU standards and requirements. And that's at the heart of much of the debate that is going on currently. So the risk of divergence on this question has been a real one, and you in the insurance sector are very aware of that. This is why we have been very pleased to see a significant amount of work being undertaken by the European authorities over the recent period. We have seen real and important progress over this period, progress that we believe will make it significantly less likely that firms will be making their relocation decisions based on regulatory or supervisory comparisons. For example, the SSM, the Single Supervisory Mechanism, has recently come out with a set of guidelines on the question of substantive presence and other questions. And the central bank has been working very closely and very actively on this as part of the SSM. The guidelines that they have issued reflect in many respects similar thinking to our own in terms of the balance between robustness and pragmatism. And we will continue to work closely with our colleagues in the ECB and the SSM as the situation and thinking evolves. Now, so far as other types, non-banks of financial firms are concerned, insurance companies, investment firms, asset managers, payment institutions, of course, the SSM's guidance does not apply directly to the approach to these firms. But we expect, and we are promoting very much, a broadly consistent approach across the different sectors. But here also, in the case of non-banks and other sectors, here also significant progress is being made. Here too, we have been working very closely with our colleagues across Europe in the European supervisory authorities. The individual authorities are developing significant guidance which will set out the approach that they will expect to see adopted by national authorities when dealing with Brexit-related authorisations. And I think we can begin to see the fruits of that in the very short period ahead. So we will have guidance on these issues, which will mean that there is a similar approach agreed across Europe. And very importantly, that guidance will be given a good deal of bite, because they are also implementing mechanisms and approaches which will seek to make it likely that member state authorities will comply with the spirit as well as with the letter of this guidance when they are deciding Brexit-related authorisation applications. So I think that is very significant, very important, very welcome developments. So let me finish here. What I've tried to outline in a few words is the fact that while the single market in financial services has brought many benefits, it does continue to be a work in progress, and it faces specific challenges. And these challenges come both from Brexit and more generally in terms of ongoing challenges. The European supervisory authorities and the SSM have a key role in this. At the central bank, we very much welcome the good work that they have been doing. I look forward to now to our panel discussion. Thank you very much.